Like I've been saying all week, I think 2024 could only be the year that small cap stocks get their mojo back. There's a group that went out of style when interest rates soared, and they'll work a lot better as rates come down. Oh, by the way, as has been typical, they drastically underperformed the S&P again in today's rally. That's why I'm going sector by sector to identify my favorite small cap names for when they're ready to move. Last night it was the industrials. Tonight I want to focus on healthcare. That's the second largest group in the Russell 2000. There are 408 healthcare stocks in this, most of which are biotech names, and most of those are bad. When you drill down into the ones in our target market cap range with positive earnings and reasonable valuations, it leaves us with only 48 stocks. Let me give you my top 5 of the 48. First up is Integer Holdings, which is one I haven't talked about at all before. Integer is a major outsourced manufacturer of medical devices. When Abbott Labs, that's a charitable trust name, or Boston Scientific, or Medtronic designs them, they go to these guys to actually produce the stuff. I think this company benefits from high healthcare utilization rates, as it could take years for people to get all the non-urgent procedures they postponed during the pandemic. Integer makes regular tuck-in acquisitions to keep its technology portfolio fresh. You might think there's nothing special about an outsourced manufacturer, but I beg to disagree. When you're producing, say, pacemakers, that requires real expertise. Not just anyone can get these things rolling off the assembly line. Second small cap healthcare name I like, how about Progyny? This is a unique story that I've been loosely following since the company came public nearly 5 years ago. Had them on the show roughly a year and a half ago. Progyny is a fertility benefits management company. Businesses sign up with them to offer fertility and family building benefits to their employees. Progyny acts as a consultant of sorts for all of its clients, employees. Also, they help them pay for expensive fertility treatments. This company's been a truly rapid grower, but the stock doesn't reflect any of that growth. After a big run from the teens in early 2020 to the high 60s in late 2021, Progyny pulled back hard in 2022, and the stock's been stuck mostly in the 30s ever since then. Sideways. Sideways, by the way, is a direction. Of course, some of these, that's because Progyny reported its most recent quarter in late February. They delivered what I call a set of mixed numbers, and that was mostly because of some timing issues and mix shifts. On top of that, the guidance was downright confusing, and that's why the stock sunk 15% in a single day. But I think the business remains good. They're talking about 18 to 21% revenue growth. I like that. That's this year. 10 to 14% earnings growth. That should get them a high multiple. As I see it, the stock's enticing. At the end of the day, we still have a labor shortage in this country, which means employers are willing to bend over backwards to recruit workers. And that means offering people various benefits, and that includes Progyny. For our third small cap healthcare fave, an old favorite of ours, Owens & Minor, which came on our radar screen during the pandemic because they're a major domestic producer of personal protective equipment. Remember PPE? At the time the stock was at $5 and change, the company had a market cap of less than $350 million. By the mid-2021 period, Owens & Minor had climbed as high as $49. But once the pandemic tailwind faded away, the stock pulled back and pulled back hard. It's now come back to the mid-20s, although that's after steadily rebounding over the past 6 months. Unlike many other COVID plays, Owens & Minor put its pandemic-era profits to work by making a pair of acquisitions in the home healthcare space. Thanks to those deals, the company now has what's called a patient direct segment, which has become a big growth driver. Sales up 24% last year. I like that. Meanwhile, the core personal protective equipment business actually declined by 1.5%. I don't like that. Now, Owens & Minor had an investor day event in December where they rolled out some very bullish long-term targets. For example, they're talking about earnings per share growing at a 20% compound annual rate from last year through 2028. Doesn't hurt that last quarter was strong with a solid outlook. I see Owens & Minor as another winner in the world of higher healthcare utilization. That's a big theme of ours. Now, while the Russell 2000 includes hundreds of biotechs, I'm not eager to recommend them because the individual biotechs are incredibly hit or miss. In the drug space, I prefer the larger, more mature pharmaceutical companies, or at least later-stage biotechs that are close to bringing an actual drug to market. While I believe biotech as a group can thrive through the end of the year, speculating on individual small-cap biotech names requires a ton of research. Now, if you just want to bet on the group, go buy the field bets like iShares Biotech ETF or IBB or the S&P Biotech ETF, the XBI. Those will do it for you. That said, there's one I do like, and that's called Catalyst Pharmaceuticals, a biotech firm with 3 treatments for rare diseases on the market. This company is more of an investor than an inventor. I do prefer the inventors, but listen to this. It buys up promising early-stage drugs, then brings them to market rather than developing them from scratch. It's taken me a while to come around on Catalyst. I talked about it in January and didn't love it. But the company just successfully launched its third drug last month, which matters because the previous two drugs go off patent in the not-too-distant future. And the best part, Catalyst stock has done nothing since I told you to ignore it a few months ago. So you haven't missed anything. Finally, I've got one more small-cap healthcare play, and this is another new one. It's called Addus, A-D-D-U-S, homecare. One of the most investable themes in the industry is moving away from providing care in hospitals and towards other lower-cost settings like outpatient treatment centers or even patients' homes. Addus Home Care offers a range of services, including in-home medical care and in-home assistance with day-to-day activities for people who need help, and less upbeat in-home hospice care because nobody wants to spend their final moments in a hospital. Right now, Addus gets most of its revenue from Illinois, New Mexico, and New York, but they love to expand into new areas by making acquisitions, like a $100 million deal to enter Tennessee last year. When Addus reported in late February, they delivered a strong top and bottom line beat. While the company doesn't give formal guidance, management sounded an optimistic tone for 2024. The analysts have been falling in love with this one, and I think it's the sweet spot trend-wise. Bottom line, those are my 5 favorite ideas from the small-cap healthcare space with a nice mix of subsectors, don't you think, and some promising narratives. Now you got some new undervalued small-cap ideas for both the industrials and the healthcare sectors. Hey, listen, we're not done with this. Tune back in next week as I come through a few more sectors, starting with the financials. There's a ton of them in there on Monday. Because if this turns out to be the year of small-cap stocks, well, we need to identify the potential windfalls.
That was easy.
House of pleasure.
Rambo in California. Rambo.
Booyah, Jim. This is Rambo in San Jose. Jim, it was so great to meet you at NVIDIA's GTC event a couple weeks ago.
I like Santana Row, man. I'd toast you if we were there right now.
Jim, I'm going to have to send a bottle of phosphor to Hector for thanking him for setting up that introduction.
Oh,
Jim,
you be the man. And Hector, how much we miss Hector, how great it is. His fellow works at NVIDIA, who's just the best there is. How can I help you, buddy?
Jim, I'm starting to invest in pharmaceuticals, and there is one company in particular that I'm looking at. This pharmaceutical is trading at a low PE of 13 because of loss of exclusivity on a couple of key drugs that they've got coming up. But the street just is not giving them any credit for some major acquisitions that they're making that are potentially going to help make up for that shortfall. The company has a dividend of almost 5% that they've committed to on your show. And most important, they partner closely with NVIDIA for using generative AI to advance drug discovery. Jim, should I double down on Bristol Myers, BMY?
Okay, here's the problem with Bristol Myers. When you listen to them, they're very abject. They'll tell you, listen, it's not going to come together until 2030. They do say the dividend will be fine, but by 2030, I just say that. And my problem with that is most people are going to be impatient. They will not wait that long. If you can wait that long and take that yield in the interim, I agree with you about the whole thing, but there's no patience on Wall Street for that one, even as you and I think there should be. Now, if this turns out to be the year of small-cap stocks, well, we got to get a list of potential windfalls, right? Hopefully this one will pique your interest. Now, we have so much man money, it's just outrageous. Sell puts investors on alert to make sure you have a portfolio that can handle whatever the market throws at. So we now play our favorite, the game I know you love. We play in My Diversified to see if your holdings are defensive enough, maybe you need to make some changes. Then one of the top semiconductor analysts on the street came out with a scathing note on Intel today, and this story has been a problematic one for me. So what I'm going to do is I'm going to share what I make of the chip maker with you. And all your calls rapid fire in a special March Madness edition of the Lightning Round. So stay with Cramer.
House of pleasure.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.